Good evening. This is Ken Long from Tortoise Capital. It's the evening of 21st of August, 2009. I want to take you through the full daily report for Friday night. So we're going to look at all the pages and not just the cover page like we normally do during the week. So we are in a bull quiet. Annually, we're about 2/3 of the way up the field on the annual trading range. At 97, we are in overbought conditions. You can see how on the graphic we've gone from oversold up to overbought. In the gap statistic, 53% of the time it's been reversing the gap. The standard deviation of the gap in SPY is 7%, so up to a 7% gap is not surprising. We have Alcoa, General Electric, Travelers, Boeing, and DuPont as the max pain candidates going into Monday. We have no signals in the overreaction and the channeling systems. You can see our pivot point is now up in SPY over 102, so that's been an extraordinary move up. Weekly RSI is neutral. The slope of the 200 and the 50 are both bullish. ADX is very strong at 33.5. We're overbought. We're in bull quiet mode, and with the volatility index at 9 on a scale of 100, we're in the bottom 10% of volatility for the last 100 days. Slope of the 30-day regression line is really the only negative indicator that we see anywhere in here. It's crossed over its own 10-day moving average after it has made a more than one standard deviation move away from the zero line, the median right here. And that's a warning of a potential pullback. So that along with the fact that it's overbought is a bit of a concern. So we want to monitor our open profits and make sure that we're not giving too much back. The volatility index, you can see we're just on that cusp of quiet. ADX dipped down to 32 and now is hooked back up. Plus DI better than minus DI, and you can see on the histogram the power there. You can see the buy on dip opportunity that happened on Monday for setups. Going into Monday, you can see there. And this is a new graphic that looks at the Williams percent R, actually the 10-day index of these Dow 30 companies. Alcoa is the only one that's even below 50, and that's the only one that is not either fully fairly valued or way overbought. And so that's a concern that the large caps are all fully vested here. And let's go to page 2. I'm calling this the tactical report. The green symbols are outperformers on a daily basis today. The red symbols were ones that dramatically underperformed. On the 10-day index, you can see everything that's in the top 10% of its 10-day trading range. Alcoa and General Electric really are the only two stocks suffering at all in the Dow. They are serious laggards, and Alcoa is just plain miserable right here. You know, it's red on the 10-day and the 3-day max pain, and we saw before that was the only one that was undervalued on a 10-day basis. Over in the ETFs, materials and energy are doing well. Europe did well today. Natural gas has just been getting murdered. Asia less Japan and the treasuries. You've seen these on the first page already, just a little bit larger, a little easier to read. Daily market performance, these are all the large liquid regional ETFs that correspond to that second ring and the inner ring of the world market model. Plus, I like looking at gold, oil, and commodities. And this gives me a quick scoop of what was going on. Index overreaction, no signals fired today. This is a safe zone exit strategy concept from Dr. Elder's book, From Come Into My Trading Room. And what this does is examines the difference between signal and noise. Signal is price that is higher than yesterday's high and contributing to a strengthening trend. Noise would be anything that is counter trend. In other words, price below yesterday's low. And his book goes into greater detail. I use it sort of as a channeling frame to see, is the trend getting stronger or weaker? So it's a variation of how he uses it. Everything that's in green is a case where the trend is stronger than the average trend of the last 20 days. So everything was just dominating today. Basically, everything was melting up. This is a volatility summary. Everything in red is extraordinarily quiet on a 100-day basis, and things in yellow are in between the average and one standard deviation below average. So we can see the NASDAQ, small caps, and blended commodities are more volatile on an average basis than their peers. Right now, Latin America is the least correlated to SPY. That's of interest. The S&P 100 is very strongly correlated to it. That shouldn't surprise us. Everything in red. Now, Latin America is really standing out from the rest of the world. There's something going on in Latin America that's of interest. It is moving out uncorrelated to the rest of the broad indexes in the world. That's pretty interesting. The Dow Daily Max Pain Report, you've seen a variation of this one before in the tactical report, so I'm not going to repeat other than just to highlight Alcoa once more. The quality report on the Dow, I sort by the quality of 2 months ago, and I like looking for things that were horrible 2 months ago and now are getting better, so I'm automatically interested in GE. It was miserable on a quality basis 2 months ago, has improved into above average on in the last month, and then here this first column is the difference between the 30-day and the 60-day quality scores, and things that are in green are really standing out compared to the peers in the Dow. So I'm interested in General Electric, Caterpillar, DuPont, JP Morgan on the basis of dramatically improving quality 2 months versus 1 month ago. In the first column, the 1 to 30 days, those that are in green are ones that are extraordinarily outperforming. So that's Hewlett-Packard, Dow, DuPont, and Caterpillar. So Caterpillar and DuPont are going to be of interest. 5-day slope of the 50-day moving average, that's kind of a secondary indicator for me. As long as it's positive, that has had favorable implications for future performance, and they're all positive. And then the percent stretch above the 200-day moving average is of interest. How much more stretch is there left on a historical basis? The stretch right now, they're all coded green, and that means they are all more than one standard deviation above average compared to the last 180 days. We'll just take a look at SPY. It has stretched 18%. Historically, the most it has ever stretched was 24%. In the last 200 days, the most it's ever stretched was 18.28. So we're right at the peak of stretch in the last 200 days for SPY. And that's why its index value is at 100. So that's a quick look at the daily, one more page here. These are the details behind that little summary gap stat that we see in here. I have been experimenting with the forecasting function in Excel to see if the size and direction of the gap can be used to forecast follow-through for the rest of the day. It takes a very strong correlation coefficient to make that leap of faith. It rarely does, and so I have really just reduced myself to taking a look at the gap statistics of the last 30 days and then using the standard deviation of that to help me assess the amount of overnight risk that I really need to be protecting myself against. So that's a look at the complete daily report. Thanks for your attention.